Hey, welcome to today's free credit training. I'm so glad that you registered and are taking your credit seriously. Today, we are going to talk about how to raise your credit score and qualify for better interest rates. So let's jump right into it. So I know many of you are probably here on this free training because you are ready to improve your personal credit and overcome your challenges. Many of us have probably all been in the place where we feel stuck, overwhelmed, we're confused when we look at our credit reports. Maybe your credit scores have plateaued and you have no idea just how to get that additional boost or improvement that you're needing so that you can qualify for better interest rates or so that you can be eligible to make your next big purchase, such as a new car, maybe refinance your home loan on your existing house, even get better credit cards with better interest rates. So your credit is involved in all of those different moving pieces. Maybe you're someone who has business interests and you're wanting to improve your credit so that you can make a sizable investment into a new business venture. All of these things involve your credit. And so today we're going to talk about how to improve your credit the right way. And hopefully you're able to apply some of these tools and resources that we're going to talk about into your personal credit journey. So let's go ahead and get started. I want to make sure, just a quick check before we jump into the nuts and bolts of the material we're going to discuss. Make sure you're in a quiet space. Make sure you've limited your distractions. Of course, you want to check the volume. Hopefully, you're able to hear me. I will try to speak a little slowly, but I am a fast talker. So make sure that your volume is turned on and that you grab a pen and paper and take as many notes as possible. So first, I want to start with just a brief introduction. My name's Karina. I am the CEO of Go Deluxe Financial. We are a financial consulting company, and we specialize in consumer finance education and credit restoration. I am extremely passionate about all things credit, all things consumer finance, and I really love helping people understand how credit works and how to restore your credit score. It's so important. It's essential that you know and understand your credit reports, your credit profile, and how to position yourself so that you constantly have leverage to have better interest rates and to confidently apply for loans and new credit, as you see fit in the future. So that's a little bit about me. Now, here's what we're going to talk about during the free training, and here's what you will learn. How to read your credit reports, number one, how to leverage the 5 factors of the FICO scoring model and strategically apply them to your credit, and then how to leverage consumer protection laws to strengthen your credit profile, which I can't wait to dive deeper into that. And we're also going to touch on how to lower your debt to income ratio, which this is a key component that lenders review in addition to your credit reports to determine how risky you may be to lend to. So debt to income ratio is a key aspect as well. Now, this training is not for you if you are someone who's comfortable with where your credit score is, if your credit score is below a 700 and you're paying higher interest rates and that's of no concern to you, then this is not the place for you to be, okay? If you're not in a position where you are committed to improving your credit and just being more financially responsible and, enhancing your financial literacy and becoming more stable in that area, if this is not the season where that is your focus, then this free training may not be beneficial to you. Also, if your credit has been holding you back and you are in no rush or have no sense of urgency to make a future investment into, an investment property or buying a new home or a new car, then this free training may not be most beneficial. So, and also, of course, if you're someone where you have immaculate personal credit, then stay tuned. Maybe this is just the place where you'll take a couple of notes, but this may not be the ideal training for you either. So just want to cover those bases. But if you are committed to improving your credit and you're ready to learn how to raise your score, stay tuned. So let's jump into it here. The first thing we always want to cover when talking about credit is where to get your credit reports from. There's so many resources out there. I'm sure many of you use a variety of different platforms. You know, you have the Credit Karmas, the Credit Sesames, the Credit Wise, your different banking or credit cards probably have a platform that you use with them. Of course, there's annualcreditreport.com. That's always number one because that is a free resource where you can obtain all three of your credit reports with all three credit bureaus, TransUnion, Equifax, and Experian, completely free. And since, what is it, April of 2020, at the onset of COVID-19 or the onset of the pandemic, the annual creditreport.com website has made it available where instead of getting your free credit reports once a year for free, you now can access them weekly for free until further notice. The original cutoff date was April of 2021, and they have since extended that. So I say take full advantage of the access to free weekly credit reports while you can. Now, the key thing to mention with annualcreditreport.com is that it does not provide you with your credit score, only the data on your credit reports. What you're going to learn as we dive deeper into this conversation, that the data on your credit reports is far more important than the score. The score is simply just a number that is computed from the data. So whether you see a 500, a 622, a 783, a 476, whatever numbers you're seeing when you take a look at your credit scores, those numbers are simply funneled through an algorithm, or excuse me, those numbers are the end of data that's been funneled through an algorithm, okay? So credit bureaus house data. So that is why annualcreditreport.com is such a great resource. MyFICO.com. Now there is a cost associated with MyFICO.com. Of course, they have a membership. Most websites do outside of annualcreditreport.com. This is where you can view the various versions of your FICO scores because we all have multiple credit scores. There is no one credit score, okay? That is why you see different variations on different platforms, okay? And we're gonna talk a little bit more about that as we move forward. If you are someone that is preparing for home ownership, or home ownership is a future goal of yours, whether it be in the next 12 months, 2 years, 5 years, you definitely wanna make the investment of becoming a member with myfico.com to take a look at your mortgage FICO score. That is going to be a different credit score than the other credit scores that maybe an auto loan lender, auto finance company would see, or a credit card company that's reviewing your application would see. Your mortgage FICO scores are, they are rated differently. The data is rated differently. And typically our mortgage FICO scores are a bit lower than our other score variations. And what I mean by that is, even if you have, let's just say you have an 800 credit score, say your FICO 8 is an 800. Your mortgage FICO score may be a 760, a 740, it could be a 770, right? The data with the scoring version for a mortgage lender is weighed a little more strenuously, and it's weighed a little heavier than what a credit card company or an auto loan company would weigh that data. So definitely make sure that you're tuning in and tapping in with myfico.com. It's a great resource. I believe their monthly membership fees range from $19 a month to $39 a month, but double check that, for yourself just to be sure. Of course, you can also establish profiles with Experian, Equifax, and TransUnion.com websites. However, this can get very pricey. If you're paying, $21 a month here, $21 a month here, and $21 a month here, that can add up really quickly. But these are viable options as well, okay? Also, keep in mind that if you are someone that already has, say you have a membership with Experian.com only or Equifax.com only, just keep in mind that you are only looking at data with one bureau. So there are things that may be on your Equifax report that aren't on your Experian report, or there's data that may be on your TransUnion and Experian report, but not listed on your Equifax report. So that's why it's really important, if you can, to take a look at all three of your credit reports And that is where tri-merge credit reports become an option. So sources like identityiq.com or privacyguard.com, those are two credible sites and platforms where you can access all three of your credit reports in a 3-in-1 fashion, where you can see all of the data side by side. So that way you're getting a full snapshot of everything, okay? So let's jump into how to read your credit reports. And we're going to cover, what fields to take a look at when you're pulling your credit reports from these different platforms. The data is going to be outlined differently. It's going to look a little different on each platform. But I want to give you just a good general sense of what you're looking at and what to be looking for, okay? So this is just a friendly reminder again, that as a starting point, you can get all three of your credit reports for free from www.annualcreditreport.com. And again, here's the language that I was referencing in the previous slide, where during the COVID-19 pandemic, you can access your credit reports for free once a week, once every 7 days until further notice. Whenever this changes, it'll just go back to once a year as it's always been prior to April of 2020. And hey, it may never change, who knows? So take advantage of it while it's available. So our credit reports are typically broken down into these fields here, in these 5 sections, okay? We have a personal information section. We have an account history section. This account history section is gonna list all of our accounts, our open and closed accounts, your auto loans, your student loans, your medical collections, hopefully you don't have any, but if you do, any collection accounts that you may have, credit cards, any store revolving lines of credit you may have, any data that is being reported to your credit reports from an account either you once had, within the last 7 years, unless it's a student loan, or that you currently have, is going to be listed under account history. Personal information, of course, is going to be your name, your addresses, current and previous addresses, and then any employer information will be listed there. On your annual credit reports, you may also see, of course, your phone number or previous phone numbers listed as well. And your date of birth is also listed. Public records, right? Any bankruptcies, judgments, tax liens would be listed under this section. Inquiries, anytime that you have applied for a new credit or for a new loan and there was a hard pull made on your credit profile, that will be reported under the inquiry section of a credit report. And then lastly, creditor contacts. This is going to be the contact information, the name, the phone number, and mailing address for any creditor or debt collector that's reporting data to your credit reports, okay? So say you're thinking, hey, I have this card with XYZ creditor, or I have a collection account that's on my credit report or a charge off on my credit report from XYZ creditor. How do I get in contact with them? Right? Of course, yes, you can Google is our friend, but you can also take a look at your free credit reports. And typically this information is listed at the very bottom, if not at the bottom of the section that is listed in your account history. And you can see the name, the mailing address, and the phone number, okay? Now, I do not recommend calling your debt collectors, but we'll talk about that later on. However, if you want that creditor contact information, that's listed on your credit reports as well. So these will be the 5 sections of your credit report. Now let's take a look at some examples from an Identity IQ tri-merge report. And this is again what I mean by a 3-in-1 credit report, where you can see each bureau and the data on one snapshot. When you use other platforms, if you use them individually, you would just be looking at TransUnion data, or just looking at Experian data, or just looking at Equifax. So in this tri-merge report, in the personal information section, you can see there are several different rows. Of course, for privacy, we blocked out this person's information, but typically it's going to show the date that you are actually taking a look at your credit report. Keep in mind that data changes regularly. So your data on your reports, they're getting older. The account information is aging. You have new data that's reporting, new updates being made. So you can be looking at your credit reports today and then take a look at your credit reports in 15, 30 days, 60 days, and the scores may be different, the data may be different. okay? These documents, or your credit profile rather, is ever changing. So here, as you can see, your name would be listed here. Sometimes this information is inconsistent. So let's just say your name is Suzy Q and it's S-U-Z-Y. It may be listed as S-U-Z-Y here. It may be listed as S-U-Z-I-E here. It may be listed as Suzanne, here. So these are what we would call kind of discrepancies in your personal information, because your name should be listed consistently the same way across all three credit bureaus, because they are three separate entities, okay? Any former names, say you were married and are now divorced, or say you have your maiden name if you're a woman, and you're now married, your married name may be here and your former name may be here, or any type of name changes could possibly be listed in this section, okay? Date of birth, of course, will be listed here, and then your addresses. A lot of times this information is inconsistent as well, or just outright wrong. So remember, the credit bureaus, they house data. They get your data from other third-party agencies and third-party companies, or just anytime you've ever filled out an application for an apartment, for a car, a student loan, a credit card. Anytime you are submitting your data for credit at any point in your life, that information, is captured, right, and housed by data housing companies, and credit bureaus get that information from them, as well as, of course, your creditors and debt collectors. So this is where the variation in your addresses come from, and it's something that you definitely want to make sure is cleaned up and consistent. And then, of course, any employer information will be listed here, whether you're self-employed or employed by an employer directly. So jumping into just a few examples of what your account history section could look like, okay? So this is an example of a credit card that is open and active, and you have several rows here, which we're not gonna be able to cover every single row in this free training, but I just wanna give you a glimpse of what the data on a credit report would look like, okay? Whether you were looking at the individual bureau or you were looking at a tri-merge report. So you can always tell the account type. This is a revolving line of credit. If this were a student loan or an auto loan or some other type of loan, it would typically either say educational for a student loan or installment, okay? Of course, the type detail, this is a credit card. And we can also tell just by the name of this entity that this is a credit card, okay? And then the balance, say you owed a balance on your credit card at the time that this credit report is pulled. This would reflect here. So at this moment, you don't owe a balance. That means you have paid your balance down. The credit limit is listed here. So this is a credit card with a limit of $500. The high credit section just shows that as of the date you are reviewing your credit report, this is the highest that you've ever spent on this card. So let's just say at some point in time, you've maxed out this limit. Say in the past, you went to $550. Which is a no-no, right? But let's just say that you use this card up to $550 and went over your limit. The high credit limit section would be listed as $550, even if the balance is $0, okay? So you always wanna make sure that you're utilizing 30% or less of your open credit cards, okay? Of course, payment status is current. So that means there's no late payments on this credit card as of the time that this credit report is being reviewed. Date of last activity is pretty much just the date that any activity, whether it be a phone call to this creditor or any transaction took place, that'll be listed here. And then the date that you last made a payment would be listed here, okay? And you're gonna see some variations because some bureaus will report it down to the exact date of last payment, such as in this case, March 19th. And then some bureaus, just for consistency, because they're reporting so much data from so many different consumers every month, they'll just pick the first of any month, okay? So this is kind of what a credit card would look like. Say this were a credit card that you had closed out, which I don't recommend closing out your credit cards because it can shift your utilization ratio and drop your credit score. If you had closed out this credit card, it will still report to your credit reports. The account status will just say closed. If you were delinquent on this credit card, let's just say you never paid it off and it was sent to collections, it was charged off and sent to collections, then that would show here. Okay, so it would say, a collection account. So that is just an example of an open credit card. So let's take a look at a collection account. So sometimes on your credit reports, you may see two names, okay, for the account name. This is typically going to be the name of your third-party debt collector that has purchased the debt from the original creditor. So the original creditor in this case was Progressive. This person was delinquent, past due to the point of no return for whatever the reason was. And consequently, this account was charged off and sold to a third-party debt collector. So this means that Progressive has counted the $367 that was owed to them as a loss, and they sold it to a company called Kane Weiner. There are several hundreds of thousands of, collection agencies out there that go by all types of names. Some of them are recognizable names that you may be familiar with just from, having a collection account on your credit report. And then some of them you may have never heard of in your life. So just a quick Google search, and you can, double check, the information on that third party. And also remember, the creditor contact section should list the information for this third party debt collector. So something that a lot of people don't know is, some people want to know, well, when did this go to collections? I never knew that my account was charged off and sent to collections. I never knew that happened. When you look at a collection account, which is the type and the account type here on your credit report, always take a look at the date opened. The date opened will tell you the date that the debt collector obtained this new account, and then reported will show you when they began reporting. Now, if this collection has been on your credit report, for a while, a couple of years, the date last reported may vary. However, if you have a brand new collection account that has hit your reports and dropped your score, and you're like, oh my God, when did this even happen? I have no idea. Take a look at date open. Now, something I want to let you know that is not commonly shared is that a debt collector, a third-party debt collector, can buy your delinquent debt from the original creditor at any point, and they can choose to not report it until they get ready. So let's just use this for an example. Kane Weiner, in this example, purchased this $367 debt that was charged off by Progressive. They bought the debt from Progressive for pennies on the dollar. Now Kane Weiner is attempting to collect on this debt, and they want you to pay them $367. So they bought this debt in December of 2020. Kane Weiner, they could choose to report it in March, which in this case they did, or they could hold on to it, and you may never know that Kane Weiner has this debt, and then they decide to report it in October of 2021. Or they might wait a year before they slap it on your credit reports. Either way, this typically happens at a really inconvenient time when you least expect it, when you're trying to buy a house, trying to buy a car, and then boom, this derogatory mark is placed on your credit reports. There is no law as of this moment. There is no law that governs a time frame for when a debt collector or creditor has to report the data. The laws only govern and outline that if and when they choose to report data, that it must be accurate and verifiable. So a lot of times debt collectors will buy a debt and just hang on to it as leverage to slap on your credit reports whenever they get ready, okay? Now, if you've ever disputed an item on your credit report, there's a comment section, and typically any notes from the credit bureaus will be listed here. So in this example, customer disputed account, okay? Clearly the dispute did not lead to a removal for this particular person who disputed this account themselves, because it's still on the report and it's just notated, okay? Auto loan, this is a paid collection example, okay? So this is an installment type, the account type detail, this was an auto loan, the status is derogatory. Now, one thing I want to reference here, sometimes in this section, you will see joint. Joint will typically be if you and say your spouse, both of your names were on this loan, then it will be listed as joint. Sometimes you'll see that with mortgages that are reporting to your credit profile. Monthly payment is 0 because it is a collection now. If this were just an open auto loan that you were paying every month in good standing that was not in collections, then your monthly car note would be listed here in this section. Okay, and this is through Chase Auto. They have charged this account off and it is now within their internal collections department. Okay, so Chase has not sold this debt. In this case, they are keeping it in-house. However, it has been charged off and it's in their internal in-house collections. Okay. Now, in this instance, this individual, they chose to settle for less than the $8,800 that was owed. Okay. And that's notated here in the comments section. And then date of last payment, date of last activity, as you can see, was a couple years ago. And so this, unless disputed, for inaccuracy or any unverifiable information, would fall off the report after 7 years from the date of first delinquency. Okay. Now let's talk about inquiries. Again, anytime that you apply for new credit, a hard pull is made, and a hard pull does impact your score and will be listed in the inquiry section of your credit report. Soft pulls, such as pre-approvals, or when you are applying for a new job and maybe your new employer is doing a credit check or so on and so forth, those will be considered soft pulls, and they do not affect your credit score. So all of your inquiries would be here. So any credit you've applied for in the last 2 years will be found here. Inquiries are 10% of your credit score, and they really only impact your score within the first 12 months. And as they age in the first 12 months, they impact your score less and less. And the date of the inquiry, as you can see highlighted here, will be listed as well. It'll also tell you on your credit reports which credit bureau this inquiry is listed on. So just something to keep note of again. All data is not necessarily reported to all 3 credit bureaus. Companies, it's at their discretion to choose if they want to report your information to all 3 credit bureaus or just 1 or just 2. Okay, so this Capital One, right? These inquiries were reported to all 3. This particular inquiry, as you can see, is listed only with Equifax. This particular inquiry, as you can see, from July 2020 is only reporting to Equifax. So this inquiry is not going to be on the Experian and TransUnion report. This also impacts why your credit scores are so different, not just with inquiries, but even with your account history and account data. Because each credit bureau has different data on you, and it can be inconsistent. And so that's why you have a variation of credit scores. Now, this is something that's extremely important to know, that 80% of credit reports have errors on them. And this information was gathered from a study that was completed by the Federal Trade Commission, the FTC, which we'll talk about later. And it came back that 80% of our credit reports have errors. Now, when we say errors, that doesn't necessarily mean that the information you're seeing on your credit report isn't yours, right? You may be looking at that collection account or that closed credit card, and you're like, I know I did that. That was me. I know I maxed that card out. I know I was delinquent on, this bill or what have you. An error doesn't mean that it's not yours. What an error means is that the information being reported by the credit bureaus and or the creditors or debt collectors is not consistent. So if you have a credit card with XYZ company and you have $1,000 limit and the balance that you owe is $200, you've only used $200 on this $1,000 credit card, that should be reporting the same way with Experian, TransUnion, and Equifax. Oftentimes what you will see is that, Experian may be showing your balance as 0. Experian may be showing that you paid the balance on a $1,000 credit card limit. Equifax may be reporting that you owe $200, but the credit limit is $500. You have a $500 credit limit. And then Experian may be reporting the accuracy of, you owe $200 on a $1,000 limit credit card. These are errors. The information should be fair and consistent across the board. And the bureaus are responsible for ensuring that accuracy of the information they report. So a lot of times these errors negatively impact your credit profile, and of course, ultimately impacting your credit score because the data is inconsistent, incorrect, or unverifiable. These reporting errors are also a violation of your consumer protection rights. There are laws that are in place to protect you as a consumer from erroneous reporting and from credit bureaus just slapping whatever information on there because they are dealing with, millions of reports and consumer data, every day or every year, that naturally they are not meticulously taking their time to ensure that their reporting is accurate. And so that's where a lot of these errors come into play, which you can dispute. So let's talk about the 5 factors of the FICO score. Credit scoring 101. There are 2 key credit scoring models. You have the FICO credit scoring model, which I would say 90% of lenders use. And then you have the Vantage scoring model. Okay. Typically, if you are utilizing a free credit monitoring platform, you are 9 times out of 10 getting your Vantage score. Now, I'm not saying your Vantage score doesn't matter. I'm not saying your Vantage score is bad. However, the Vantage score, the Vantage model of credit scoring scores your data differently. And that is why a lot of times your Vantage credit score is higher than your FICO credit score. So if you check Credit Karma, for instance, that is your Vantage score. And they're only pulling data from one bureau. So that's another thing. So you may look at Credit Karma and say, oh my God, I have a 700. And then you look at your FICO score through another platform like myfico.com or another resource, and you're like, wait a minute, I have a 640. Which one's accurate? Well, they're both your credit scores. They're just different models. And a lender is 9 times out of 10 going to be using your FICO score. So that's what we focus on. When you are applying for a mortgage or you're applying for an auto loan, typically they are looking at your FICO score, okay? Now there's different versions of each scoring model, okay? And the way I like to explain the versions of a scoring model is think of your cell phone, whether you have an iPhone or an Android. Let's use an iPhone because that's what I'm most familiar with, okay? So of course there's the iPhone 4, 5, 6, 6S, 7, 8, 9, 10, 11, 15, right? The purpose and function of the iPhone is the same. You can make calls, you can receive calls, you can text, you can check your email. However, the operating systems and the features on each phone are different with each version, right? And how information is, transported and all of that back-end techie stuff, right, is different with each model of your cell phone. It's the same idea with credit scoring models. So there's the FICO 2, 3, 4, 5, 6, 7, 8, 10. Different companies, different creditors use different versions of the scoring model that they choose. So for instance, a mortgage lender is going to use FICO scores, 2, 4, and 5, for instance. They use a different version, whereas a credit card issuer may likely be using the FICO 8 version of your credit score. So each scoring model, just think of it as the different versions are different math equations. And so your data is funneled through these different math equations, depending on what version that company is using, and you're getting different scores. So we have over 300 credit scores. And as I stated before, these numerical variations depend on the model version and the data being used. So let's just say if you have more positively reporting data on your Experian report than you do your Equifax and TransUnion report, your Experian credit score may be a little higher, okay? Same thing that goes with your TransUnion or Equifax scores. Remember, the data on your credit report is more important than the score. That's why you want to make sure that the data is accurate, verifiable, and consistent, and that you are leveraging your consumer protection rights as much as possible. Now, we will talk about the different 5 factors here. That's what this screen capture is for. So starting with the highest, payment history is 35% of your credit score, your FICO credit score. This is why late payments kill your credit score so much. One late payment, especially if you are someone with good credit or close to good credit, can drastically drop your score. You always want to make sure that you have immaculate payment history. And if you haven't in the past, that's okay. There is no time like the present to get started, okay? Make sure that you are paying all bills on time. The next factor is going to be utilization, credit utilization, or amount of debt. It's also referred to as, which is 30% of your FICO score. So this is why you want to make sure that your credit utilization is ideally around 10%, but just as a starter, if you're just beginning and working towards improving your credit, bit by bit each month, focus on bringing your credit card balances down to 30% utilization or less. So that means, say you have a credit card with $1,000 limit, you want to make sure the balance on that card is $300 or less. Okay, if your balance is above $300 on a credit card with $1,000 limit, you are now entering the space of high utilization and your score will be negatively impacted. The lower the utilization, the better. However, you do want to make sure that you are actively using your credit cards. You're just not maxing them out and you're using them responsibly in a way where you are able to pay off the balance in full each month, each billing cycle, okay? So that's 30% of your FICO score. The two highest are payment history and credit utilization. The third is going to be length of credit history or your credit age, which is 15% of your score. This is something that can't be rushed. This is a part of your credit score. So sometimes people feel very stuck. I've been at 650 for so long. Oh my gosh, I've been at, 620. I've done so much work to improve my credit score and I'm just stuck. Well, the age of your accounts on your credit report may not be that old. If your oldest account is 4 years or 5 years, you will have to allow some time to pass for your length of credit history to get a little older. Typically, our student loans are the oldest items on our credit reports if you're someone that has a student loan. And so that kind of will help with your length of credit history by default, especially if you're a little older, okay? So typically you want to have accounts on your credit reports that are older than 5 years to aid in the length of credit history. New credit or inquiries is 10% of your credit score. Okay, now I always love to say this because it's true, just kind of a reality check for most of us. But if you are someone with, bad credit and your credit is not where you want it to be, it is not because of inquiries. While inquiries do matter, it's only 10% of your score. And as they get older, it weighs less, right? It weighs less. Typically, if your scores are low, it is not due to inquiries. It may be due to length of credit history. Maybe your accounts aren't old enough. They haven't had enough time to age. Maybe you have high utilization. Maybe you have a lot of late payments within the last 2 years. The data on your reports within the last 24 months weighs the heaviest, okay? And then lastly, the credit mix, which is 10% of your credit score as well. What is a credit mix? That means the types of accounts you have reporting. How many revolving lines of credit do you have? How many installment accounts do you have on your credit reports that are active and open, okay? Credit mix ideally, as a rule of thumb, you want to be sure that you have 3 revolving lines of credit, which would typically be, say, a credit card, and then at least 2 installment accounts reporting to your credit profile. That is the foundation to building a strong credit profile and improving your credit or building your credit over time. If you have a student loan and an auto loan, for instance, already on your credit reports, then you've already met that threshold of having 2 installment accounts. Okay. Also, one thing that I want to go back to referencing as far as the differences between FICO and Vantage and how one of the distinctions between them is that how they score the data is differently and the math equations used are extremely different. The reason why a Vantage score is higher is because a Vantage score only scores open accounts. So anytime you have a closed account or a paid off account on your credit report, paying off a debt does not delete it from your credit reports. It will still report to your credit profile. It will just report as closed. So FICO scores open and closed accounts, whereas Vantage only scores the accounts that you have open. So that's one distinction as well, okay? So let's move right along. Poor credit is expensive. And I know we know this, especially if you're someone like me who has had bad credit in the past, right? Ask yourself, what is your credit costing you really? No matter how much you're smiling, no matter how many vacations you take, no matter how much you are making do and making lemonade out of lemons, which I commend you for, if your credit is below a 700 or it is in a subprime range, it's expensive. It's costing you, right? Behind the scenes, high interest rates on loans and credit cards, limited access to financing options, which is huge. You may be often low on cash, right? Not very liquid due to large minimum payments, or just your bills are piling up because you're trying to pay back, all of the credit card debt or the loans in which you're indebted for. You're paying more expensive insurance premiums, higher deposits being required for utilities or for rent when you're on your apartment search. This is all due to your credit. Also, the ability to qualify for a mortgage, right? You may know or hear that, hey, all I have to do is have a 580 to get into a house. Well, some mortgage lenders will require you, based on their lending programs, to have at least a 640. And to be quite honest, you want to have at least a 640 or better. The better your credit, the better interest rates you have long term, right? It's same thing with a car. Just because you can get into a car, who wants to be paying, $700 a month on a 2010 Kia, right? Nothing wrong with driving a 2010 Kia if that is your vehicle of choice. However, you don't want to, be paying an arm and a leg for that because your credit was below the good credit range. Okay, so bad credit is expensive. It costs more to not fix it, to not pay attention to it, than it does to pay attention to it and to improve it. And going back just to what I shared with you previously about the data, I have to drive this point home about the data on the credit report is way more important than the score. Remember, the score is really just a number that is spit out from how the data is funneled through the credit scoring math equation. Okay, that is proprietary. None of us know all the ins and outs and the square roots and the dividends and the full math equation behind the scenes. That's proprietary and it's owned by FICO or it's owned by Vantage. Okay. Two people can have a 700 credit score and one person could still be denied credit or a loan because the data on the credit report. This is why we don't recommend people investing in credit sweeps and all of that crazy stuff, because that does not improve your credit score and it's still not guaranteed for you to be approved, because underwriters, they don't just look at a number, they look at the data. So if you have a 700 credit score somehow, but you still have, 3 collection accounts on your credit reports that may be aging, that could possibly lead to a denial of a certain credit card. For instance, Amex, which is a wonderful company and a wonderful card to have. They have pretty strict guidelines with credit approval. So even if you have, a pretty high credit score, if you have, a couple of late payments still on your credit reports, or you have some accounts that are in collection still, you can be denied an Amex credit card. Whereas someone who has a 700 plus credit score and doesn't have those things on their credit reports, and all of their information is accurate, verifiable, and it checks out well, they would be approved. So those are some distinctions. And this is why I stress that the data is more important than the score. Now, some important laws to know. You have to know your consumer rights. One of my favorite sayings is that when you know your consumer rights, these debt collectors and these creditors cannot play with you and play with your financial livelihood. So the first consumer right and Credit Reporting Act to know is going to be the FCRA, which stands for the Fair Credit Reporting Act. The Fair Credit Reporting Act, it's a series of laws that governs the guidelines that credit reporting agencies such as TransUnion, Equifax, and Experian must abide by when reporting information to your credit reports. Okay, this goes back to the law that states that all information being reported to your credit reports must be accurate, verifiable, and it cannot be, obsolete data. So you should not have derogatory marks on your credit report from 15 years ago. right? That would be considered obsolete. Okay, and then the next is going to be the FDCPA, which is the Fair Debt Collection Practices Act. This is the main federal law that governs debt collection practices, and it governs and outlines what debt collectors can and cannot do when trying to attempt to collect a debt. Now, debt collection is legal. It's a common misconception somewhere, I don't know why, that debt collection, the practice of debt collection is illegal. It is a legal practice. However, the methods in which these third-party debt collectors attempt to collect a debt, they must follow the FDCPA regulations and guidelines. They cannot use abusive, unfair, or deceptive practices to collect on a debt from you. And then lastly, the FTC, the Federal Trade Commission, which they protect consumers by stopping unfair, deceptive, or fraudulent practices in the marketplace. They conduct investigations as needed. They sue companies. You guys may have heard things about, certain companies being sued by the FTC, and they even sue people that violate, consumer protection laws. So sometimes there may be debt collectors or other agencies that have been sued by the FTC. For basically screwing over consumers and using unlawful practices. So they also have great educational resources to educate consumers and businesses about your rights and responsibilities as a consumer. So these are the top three. There are definitely some other consumer laws and consumer protection laws that you should know, such as the Fair Credit Billing Act and so on and so forth. But you cannot go wrong with the FCRA, FDCPA, and FTC. Now let's jump into the debt to income ratio, especially if you are someone that you're looking to purchase a home, whether it be in the near or far future. DTI is essential. So many of us get so caught up in just the credit reports and the credit score. You can have the most immaculate credit report in the world, and your debt to income ratio is 60%, which is considered pretty high, very high, and be denied a mortgage loan. So lenders evaluate your debt to income ratio to help determine how much of a risk you are to lend to. And ultimately, the DTI is comparing how much you owe each month, how much debt you have, to how much income you earn gross each month. And that's what this percentage is calculated by, okay? Now, it's the income that you earn before taxes that goes towards, your rent payments, your mortgage, credit cards, student loans, or other debt. Your light bill and your electricity bill, or your shopping habits, your entertainment expenses, those are not calculated under DTI, okay? And let's talk about an example. So let's just say, just because I'm an example person and I'm visual as well, and you may be too, these are your monthly debt payments. Okay, you have rent, you have your car note, you have your student loan payments. Let's say your student loans are consolidated and it's $400 a month, okay? And some other debts, whether it be credit card payments or what have you, because that would be factored into DTI as well. And that comes out to $200. So all of your monthly payments or debts total $2,000 a month. And let's just say your gross monthly income is $4,500 a month. So before taxes, you earn $4,500 a month. And you can prove this through bank statements, right? Which a lender would require, okay? Your debt to income, which is this equation here, would then be 44%, which is pretty good. Ideally, you want to be around 43%. Now, different lenders, right, they have, their own in-house policies and things that they're willing to work with you on. So I'm definitely not going to speak for all lenders. However, with Go Deluxe Financial and myself, we have different partnerships and relationships with different lenders and mortgage brokers who share a wealth of knowledge with us about their process and what they're looking for. And so that's how we like to share this information just with our community, and especially in this free training. So 44% is pretty good. Let's just say your gross monthly income was $5,000 a month before taxes, but all of your monthly payments and debts were at $2,500 a month. You would be at a 50% DTI, which is high. You definitely want to be below 47, ideally, okay? Anywhere around 37% to 43, there's that wiggle room. But as you start going, closer and closer to 50, there may be some red flags there that you run into with lenders in your underwriting process, okay? So you definitely want to be paying down your debts and calculating your DTI if your focus is home ownership in the future. Now, some helpful tips, just kind of bringing this all home in this free training, some helpful tips to raise your credit score. If you do not have any open active revolving lines of credit or any open active credit cards, you want to obtain that. Do not fear or run from having credit cards, because not having any revolving lines of credit, you are missing out on about 160 scoreable points, because utilization is 30% of your credit score. So you want to make sure that you have credit cards that you're using responsibly. You can start by obtaining secured credit cards, ideally one or two, preferably two, but start with one, baby steps, where you basically can make a security deposit of, anywhere from $250 to $500 to $1,000 if you'd like, and you are essentially borrowing that money from yourself. The amount that you place as a security deposit is ultimately your credit limit. So let's just say you take $250 and you apply it to a secured card, and then you're spending, $50 or $30 a month on that secured card and paying it right off. That will help you build positive payment history and positive credit utilization and aid in your score. Keep in mind though, the end goal for secured credit cards is not for that card to become some $10,000 limit credit card. That is not how secured cards work. Secured cards are strictly a credit building tool and vehicle. They are essential and so helpful. I can't stress that enough if you are someone needing to improve your credit and build your credit over time. If you're someone that you already have multiple credit cards, or you have at least 3 revolving lines of credit that are open and active, you just need to pay those balances down. Focus on that. You may not need a secured card at this time. Your key focus will really be to pay those balances down under 30% utilization. Also, you can become an authorized user and piggyback off of a relative or friend, or piggyback off their good credit. Now, this is a nice addition, but this is not the end all be all, because when you go through an underwriting process, say for a new home, a mortgage lender can see that you're an authorized user. And while that's not necessarily a bad thing, it's not a reflection of your positive payment history and your positive behavior. They can see that you're piggybacking, and you may have a 740 credit score, but if you were removed as an authorized user from your mom's credit card, your real credit score might be a 660, or a 670 as an example. So it's a great tool. Just don't rely solely on becoming an authorized user. There's still some other work to do. Also, if you have open and active credit cards, you can request a credit limit increase on your current credit cards every 6 months. Once you make sure that your credit cards are in good standing, you've paid down those balances. I can tell you now, if you have high utilization and you are misusing your credit cards, the likelihood of you getting a credit limit increase is 0 to 0. So you want to make sure that you've proven yourself to your card issuer company. You're making your payments on time. Sometimes it may take a year to get back in good standing. And then you can begin requesting those credit limit increases, or they may even surprise you and offer you a credit limit increase just to recognize your positive behavior, your positive financial behavior and activity. Of course, again, pay down your debt, starting with your credit cards first. If you want to see what we would call a quick boost or quick improvement, one of the things that you can do is pay down your utilization to below 30%. If your utilization is extremely high, anything over 30, paying down those credit cards in the next billing cycle or the next credit reporting cycle, you will see that your score will improve just off that alone. For some people, it may be, a 30-point jump. It may be a 20-point jump. For some people, it could be a 60-point, 80-point jump, right? Every credit report is different, but it will definitely help. Make on-time payments. Of course, this is pivotal, because 35% of your credit score are payment history, or is from payment history. So you want to make sure you have no late payments. And one resource that you can use is just setting up auto pay so that you don't forget to pay your bills on time. Also, do not co-sign for any loans. If you are working to improve your credit and you want to get into a position of leverage, this is the time to focus on you. Yes, it may be selfish. Yes, someone may be mad or someone's feelings may be hurt, but your credit is on the line. Your leverage, your access to better interest rates and to better financing options in the future is on the line. Do not co-sign for any loans. You will be equally responsible and liable should that person default on that loan, and it will drastically impact your credit score as well. Focus on you, focus on restoring your credit score and building a strong credit profile first, okay? Lastly, only apply for new credit when you need it. Do not go out here applying for credit all willy-nilly just to see if you're approved. I call it the just to see method, and it drives me crazy because it keeps you in a place of disadvantage and it keeps you stifled. You should only be applying for new credit if you are applying for credit for a credit building tool, such as a secured credit card or a loan, so that you can have an installment account reporting to your credit profile if you don't have any installment accounts. You want to apply for new credit strategically and with purpose. Ideally, you really don't want to have more than about 2 inquiries on your credit reports a year, unless you are working to build credit, and even still about 2 to 3 is the max. So only apply for new credit when you absolutely need it. Otherwise, keep those inquiries low. So now with all of this information that I provided, I want you to ask yourself, what are your big goals? What is the goal that you want to reach where you need a better credit score, where it is essential to have a better credit score? Are you looking to purchase a home? Are you looking to get into real estate investing? Do you want to refinance your existing home, but your credit score is in the way? Do you want to purchase a new car? Are you wanting a better credit card with better interest rates? If you need to get your credit back on track, it's important that you be honest and upfront with yourself and write down these goals, and also write down the challenges that you're having that are standing in the way. And also ask yourself, do you feel stuck? Have you felt stuck? And in what areas have you felt stuck in trying to raise your credit score on your own? What part of the credit scoring or credit improvement process, just overwhelms you, where you're like, I don't get it. I've tried, going left. I've tried going right. I've tried going up, down, around and around, and I am stuck in figuring this stuff out. And then lastly, are you tired yet, of being denied for different loans or different finance opportunities? Or are you tired of paying high interest rates? Say you have a car and you're paying, 18%, 12% in interest, right, on a car because of your credit score. Ask yourself, are you really tired of this? Or are you okay with it? Are you okay throwing money down the drain? If so, I definitely want you to consider getting the one-on-one guidance that you need to improve your credit and reach your financial goals. And so what we have available, because you have tuned in to this free credit training as a limited time offer, we have opened a few spots for you to speak with one of our certified credit specialists today, including myself, to talk through your credit situation. We will conduct a full credit report analysis, answer any and every question that you have regarding your credit struggles, guidance on how to improve your score, any solutions that we can give you customized to your specific credit scenario to overcome your credit challenges. And we can also walk you through your credit reports and help you better understand the information that's impacting you specifically. A lot of times when we talk credit, we talk broadly across the board, which is good, right? In a training, in a free training setting. However, I'm sure many of you, just like myself at one point in my life, we have specific situations and specific things on our credit reports that are overwhelming us, where we need an expert or a professional to take a look at, and we could really use that one-on-one guidance. So we have made that available to you, where you can schedule your credit clarity call today and speak with one of our certified credit specialists to get that guidance you need. And we really pride ourselves on giving 5-star service on these credit clarity calls, where we talk you through all of the data, we lay eyes on the information on your credit reports and give you that analysis that you need so that you can have the clarity that you need in moving forward on your credit improvement journey. And we also pride ourselves on being BBB accredited as well. So if you are ready to take the next steps and improving your credit journey, and you've enjoyed this free credit training, you have learned something from this free credit training, and you are ready to make a change and you want to speak with an expert and have us take a look, go ahead and take advantage of the limited spots that we have available. This offer will not be up long, as we are stretched rather thin with our calls and helping so many clients and people just get back on track. So if you're ready to get that full credit report analysis and get a custom solution, to your situation, click the link below, book your credit clarity call today, and we can't wait to speak with you. Thanks so much for tuning in.